and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy. I am your host. And today on the podcast, I want to talk about gold and Bitcoin. Well, let's face it, I kind of have to talk about gold and Bitcoin because that seems like that's all everyone's talking about these days, except for NVIDIA, and I'm not going to talk about NVIDIA. I actually started writing this episode thinking that I'd say one or two quick things and then move on to what I actually wanted to talk about, but then it started to get long, and I said, I need to cover the whole enchilada. So the title of this episode is Gold and Crypto Are Either or Both Real. And I totally meant the double entendre with either and ether, just FYI. But before we get into that, a word from our sponsors. First of all, this episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of alternative ETFs solving today's most pressing portfolio challenges. Not only do they have sophisticated diversifying strategies like a managed futures ETF or yield curve plays like TUA, they also have the number one best-performing intermediate core bond fund from 2023, that's AGGH, and an enhanced income ETF, ticker HIGH, that was in the top 2% of its category. Check out their website, simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. This podcast is also sponsored by Enduring Investments. You've listened, you've heard, you've understood, you want to defend your money. Whether you're an individual investor or a pension or insurance company or wealth management CIO, you are charged with the defense of your money as inflation rises and falls with renewed volatility. It doesn't have to feel like a scene from The 300. Enduring Investments is there to lock shields with you, whether it's in a separate account or a private fund. Join with Enduring and take the battle to the enemy. Defend your money. Visit us at enduringinvestments.com. Before I get into talking about gold and crypto, I want to first say that there was a very good BLS webinar today. I never thought I would say that phrase, a very good BLS webinar, on the owner's equivalent rent / primary rent stuff. And I think I talked about it last week. There was this big dust up about why owner's equivalent rent this last month rose so much more than primary rents. And some of it's counting angels on the head of a pin. And at first there was, some people thought that there was something really crazy going on. And it turns out it's not crazy at all. My belief was that it had mostly to do with utilities. And it turns out that's about a quarter of the effect. The second largest part of the effect actually is the treatment of utilities. But anyway, the BLS, because there was such a dust up, they first tweeted out something that suggested that there was a group of super users who had, special access to the BLS, which of course is not true and also, a bad look. But also the answer they gave was wrong. And so they, everybody who sort of looked at this, who knows what they're doing, came to the conclusion there's nothing terribly exciting about all this, but the BLS nevertheless did a very, very informative webinar about how owner's equivalent rent works. And it is very informative, and it gets deeper and deeper and deeper into the weeds. Let me tell you, there's a part at which you, unless you're one of 2 or 3 people in the world who wants to listen to the whole thing, there will be a point during the webinar that you say, that's enough for me. I'm out. But if you go to bls.com/CPI, bls.gov/CPI, I think there's a link to it there. But had to listen to it because I'm the inflation guy, and they did a very good job. One of the things that comes across, by the way, is that, the BLS is, they're accused a lot of this conspiracy of trying to hold down CPI and fake the numbers. But I think if you read their stuff, and if you pay attention to the BLS, if you've ever met anybody from the BLS, particularly the prices division, and if you listen to this webinar, you will come away saying, yeah, these are not guys looking to be master criminals. This is the bow tied set. These are economists, they're statisticians, they are I'm sure they have partisan leanings, but the numbers are what the numbers are, and they're kind of proud of it. So, in particular, the whole owner's equivalent rent thing has always been a big complaint of a lot of the people who think that the BLS changed the methodology in the early 80s to dampen inflation. It's not true. It's demonstrably not true. The reasons they did it were discussed years in advance of them doing it, and then they did it. And but again, I think if you listen to the webinar, you'll figure out pretty quickly that these guys they're just really just trying to do their job the best way they know how, and they were embarrassed by kind of how they went off half cocked after the number this last time around. And by the way, the difference between owner's equivalent rent month on month and primary rents was 0.2%. So that's the amount that made people go crazy. It was 0.2% on a subset of the CPI data. So I'll tell you what you're dealing with here. But anyway, it is actually very interesting if you are at all curious about how the BLS uses a rental survey to account for owner's equivalent rent and why they do. There's the first part of the presentation is very well done and explains it pretty well. But then they get, as I said, deeper and deeper into the weeds, and you can listen as long as you feel like it. Anyway, so that's so I wanted to point that out. And then now let's talk about gold. Let's talk about crypto. So gold recently broke to a new all-time nominal high. Okay, and it's up over $2,100 an ounce. And I saw a chart today, and this is kind of what made me decide to talk more about gold today. But I saw a chart today in the Daily Shot from Gavical Research, and it noted that while gold is at a new nominal high, it is still well short of its all-time inflation-adjusted high in 1980. So if you divide gold by the CPI index, obviously you get something that's a lot flatter, and we're sort of close to the high, but not really all that close to the inflation-adjusted high. But if you think about it a little bit, so some people will look at that and say, well, look, so gold is not overextended. It still has a lot to go because it's just basing. It hasn't yet beaten the old highs. But that's equity type thinking. This is a commodity. And so you have to think about this a little bit differently. There is no reason that gold should rise in inflation adjusted terms over time. You start with an ounce of gold, and 100 years later, you have an ounce of gold. So the dollar value, the dollar price of that ounce of gold has changed over that time period, but that's a movement in the value of the dollar. It's not a movement in the value of the gold. The gold is still worth, 1 ounce of gold is still 1 ounce of gold. The real value hasn't changed. And so if, in fact, your inflation index is a pretty good measure of the overall level of prices, and therefore the overall a good overall measure of what a dollar will buy, then it is entirely consistent that the price of gold over time should be pretty steady in inflation-adjusted terms. If it's a good store of value over the long run, then the nominal price of gold should move up with inflation and down with the price level. So the nominal price should move up with the price level and down with the price level, and the inflation-adjusted gold price should be flat, right? So if it was a perfect store of value, that's exactly what you'd expect. If CPI was drastically underreported, as some people claim, then gold is at a tiny fraction of the level it should be. It should probably be another, probably should be over 10,000, which means that gold investors are clearly unaware that the price level is much higher. And again, this is another reason, the fact that gold over a long period of time, in this case from 1980 to now, is basically flat in inflation-adjusted terms, it's flat against CPI. It's a pretty good sign that CPI isn't wildly off. Either that or that gold investors are complete morons, that they have underpriced this commodity. They're accepting 20% or 15% as many dollars as they should, given what the dollar buys. So, gold investors must be really, really dumb. Or the CPI is a pretty good measure of the overall price level and the value of the dollar. Now, at the same time, while gold is a good long-term store of value, and by the way, I just talked about the last, 40 years, close 45 years, over, you can go back and look over 500 years or 200 years or whatever, and over a long period of time, gold is a pretty good store of value. However, over the medium term, it's a pretty bad store of value, as evidenced by the fact that from 1980 to 2000, gold lost 80% of its inflation-adjusted value. And since 2000, it's quadrupled in inflation-adjusted terms. Now, through the miracle of return math, minus 80% and then plus 300% means you're still behind a little bit. But that's obviously a pretty massive swing if what you want to do is just preserve value. So it's pretty bad hedging over decent length time periods. That's not like a 1 month time period. It's not like a 1 year time period. It's not like a 5 year time period. Over 20 years, between 1980 and 2000, you lost 80% of your inflation adjusted value. And then the time since then, you've made, more than 300%. So, gold in the very long run is a decent hedge for inflation, but it doesn't mean that it outperforms or should outperform inflation. It means it should be, if it's a good hedge, it should be equal to inflation over a long period of time. And moreover, as an investor in gold, it's important that you buy it at a decent real price, unless you're planning to hold it for 100 years. Now, back in episode 86, link in the show notes, I talked about gold. And I said that I liked gold at that time, this is back in October, for its tips-like nature. Gold tends to respond to real interest rates. And given where real yields were, it was no longer kind of one way that, like with tips, when tips were yielding minus 1% real, it was kind of hard to love tips because there weren't a whole lot of ways that yields could go down from there, but a lot of ways that yields could go up. And for the same reason, when yields were at minus 1 real, there weren't a whole lot of reasons to want to own gold at that point. But that was 10% ago on gold. Gold is up 10% since I said I liked it. And that means the expected real return over the next decade has fallen about 1% per year from wherever it was. But the starting price goes up 10%. The expected return, again, you still have the same, at the end of 10 years, you still have an ounce of gold. And so your expected real return per year has gone down about 1%. So in the long run, that real return, whatever it is, should be about zero. Okay. So whether your return was, as high as 1% per year over the next decade, and now it's flat, or if it was flat and now it's minus 1, the point is that you're worse off if you buy this 10% higher. Having said that, I do think there's good momentum in the gold price right now, and there's a lot of momentum players out there. And as long as Bitcoin also continues to spike, then gold will probably do okay, because people do mistakenly think that both of these things hedge inflation. But anyway, so I think that gold could well continue to go up just on momentum, for momentum reasons. But as a long-term, other than as a long-term hold, I mean, it's just not a really great entry price here. This isn't necessarily the point I'd want to get in gold for the first time. Okay, now speaking of crypto, speaking of Bitcoin, that's the other thing that's been in the headlines an awful lot recently, because, recently the SEC allowed, mutual funds and ETFs to hold Bitcoin and to be launched tracking Bitcoin, and as a consequence of that, the price of crypto has gone straight up to new all-time highs, to much rejoicing in amongst people that believe that everything that crypto is somehow superior to other fiat currencies. It should be no surprise that we're getting such breathless coverage because there is a whole industry dedicated to pumping up crypto, and not to mention the fact that the financial press loves to watch things go up very excitedly, and they like to watch things go down very excitedly too. And in crypto, they can get both. It is crazy talk to be very excited about what's happening here, and to think that something really special is happening in crypto. And here's why. If crypto was suddenly rallying because it was becoming more broadly used in the economy and penetrating this medium of exchange hurdle, it was suddenly being useful, if it suddenly had a correlation to inflation, and so it was rallying because inflation was surging, if there was some reason that this was no longer just a different kind of fiat money, so that it suddenly had an intrinsic value greater than zero, then I'd get more excited. But geez, folks, we just launched a mess of crypto mutual funds and ETFs, and the only thing that those mutual funds and ETFs can buy is the thing in limited supply. Let's think about it this way. If I started 10 mutual funds that were only allowed to buy 1999 Honda Civics, okay, and that's all that, there's a mutual fund that only holds 1999 Honda Civics, then the price of Honda Civics would also blast off as money poured into this mutual fund, as if, whatever, people wanted to buy 1999 Honda Civics. But suddenly, if there's a mechanism to do this, suddenly people start, they think this is really cool, and so they start investing in this, and the price of 1999 Honda Civics would also blast off. It would also be utterly stupid at that point to buy a 1999 Honda Civic as a store of value or a medium of exchange. In fact, the argument for doing so would be worse because the value would be artificially inflated by the artificially created demand. As you've created these mutual funds and money flowed in, and all it can buy is 1999 Honda Civics. The 2000 Honda Civics, they're still priced, $2,000, but that 1999 Honda Civic's now worth $15,000 because the mutual funds keep buying it. Okay, so here's another part of this thought experiment, and especially relevant for anyone out there listening who is running a crypto mutual fund. And the regulators ought to think about this too. And I think thinking about the 1999 Honda Civics is a useful thought experiment. Suppose that there were a couple of 1999 Honda Civic mutual funds, and they've been pumped up, and everyone is pouring money into these funds. And so they started buying up all the 1999 Honda Civics. Keeping in mind that the supply of 1999 Honda Civics is, like with the existing forms of crypto, like Bitcoin, the supply is absolutely limited. Okay, there's an absolute cap on the amount of Bitcoin that can be created. There's an absolute cap on the amount of 1999 Honda Civics that are out there. Okay, so what happens when I start getting more dollars into the fund and there aren't any Honda Civics left to buy? What is going to happen? Well, the price of the last couple of Honda Civics is going to be astronomical. Okay, because they have to buy these Honda Civics. They could be millions of dollars each because there's 4 of them left. Now they're collector's items, and there's 10 mutual funds that need to hold this Honda Civic, and they're bidding for this last little bit. The fund has to hold them. And when it holds them, no one else can hold them, right? So this last couple that are astronomically priced. Well, what happens now when they're gone? When all of those things, when all of the Honda Civics are held within mutual funds and more money flows into the mutual fund, what happens next? Well, let's consider a classic historical case with a limited supply is tulips, right? So classic blow off top. Eventually the price stops going up and it starts to drift lower. Then, because what happens is you take in the money and you have the same number of Honda Civics, and so the value per share has to go down. So the more money that goes in, now the value of the share of your mutual fund starts to go down with additional money going in, because you just have nothing left to buy, and so the price starts to drift lower. then people start selling your mutual fund, which means the mutual fund needs to sell off those tulips or those 1999 Honda Civics. Except there's no fundamental buyers of 99 Honda Civics at $1 million per Honda Civic, or of tulips at 6 weeks' wages, or 3 years' wages, or whatever they got to. So the price of the tulips, or the 1999 Honda Civics, starts to ratchet lower pretty fast. And so does the mutual fund, which is having to sell as fast as they can because they have increasing redemptions, because now the price of the mutual fund is dropping, and they have to sell more and more to get less and less money for the thing that they're selling. Oh, and as an aside, what happens to the capital gains allocations for the people who are left in the fund? But that's a question for another time. Maybe the mutual fund has to put up a gate at some point and stop giving money back and not redeem people. But it doesn't matter, because at some point, the thing they need to sell has a price of zero. I mean, at least a tulip is maybe worth a couple of pennies. And at least a 1999 Honda Civic can be sold for scrap. But what do you sell Bitcoin for? Who is the fundamental buyer of Bitcoin? What are they willing to pay if they know that there's all these people who have to flush out of every single unit in their mutual funds? So mark it down. I'm utterly unsurprised by Bitcoin blasting off, by various forms of crypto blasting off that can be held in these things. And I think that's going to keep going for a little while. It's probably going to feed on itself. In fact, I can't even imagine, I can't even hazard a guess as to how high, crypto, various forms of crypto could go. The answer could be many multiples of where we are now. I mean, when you get a blow off, when it goes asymptotic, when it goes exponential, it can go really, really high. But that's terrible news when that happens, because when that happens, as more billions flow into the funds chasing that performance, and we know investors chase performance, eventually, it's going to go up and up, and eventually it's going to crash. I'm highly confident of the eventual outcome. Unless for some reason the money flowing into those funds slows down for some unrelated reason. There's some weird legislation, or I don't know. I can't think of, if there's some kind of, if the SEC decides that no, if you are putting your customers into Bitcoin, then you're violating fiduciary duty. So only individuals can buy it, or whatever. If there's some kind of throttle that keeps it from going vertical, then you might not get the crash. But I can't think of a reason, and I think that it's very likely to go essentially vertical. So mark it down. I think we're going to go vertical, and then we're going to crash. And at the end, we'll have to pick up the pieces, and you hope that those companies that ran Bitcoin ETFs, you hope that they don't get really large lawsuits against them. Now, why doesn't this dynamic? We've talked about gold. Okay, we've talked about crypto. Why doesn't that same dynamic that I'm just talking about, it doesn't happen with gold? Why doesn't it happen with commodity indices, right? So, we have had in the past decade or whatever, periodically, you have a couple of decades, suddenly you have institutional money flowing into commodity indices and flowing into mutual funds. Individuals, again, chasing performance, start to run into commodity mutual funds and ETFs. So why doesn't that push commodity prices higher and higher and higher until they blow? And the answer is because commodity funds don't actually hold physical commodities. They hold futures collateralized with the cash in the fund. And so if you buy a futures contract, you don't actually hold it until someone needs to deliver live hogs to you. If you don't, then it doesn't affect the spot market, right? So you've bought with the intention to sell before somebody has to actually deliver live hogs to you. So on the day that they have the auction for live hogs, there's the same number of buyers and sellers that there usually are. All the people who were long futures contracts, they've moved to another futures contract. They don't have any interest in actually taking in live hogs. So it doesn't affect the spot market. You're closing out before it does affect the spot market. Now, actually, indirectly, this is probably academic. If the forward futures prices are high enough, if you can't affect the spot, but if you've affected the futures price enough, pushing it, because you do have to find sellers of the futures contract, right? And that tends to be limited by arbitrage concerns, that what somebody can do a cash and carry arbitrage for. But if you've pushed those forward futures prices high enough that it induces producers to produce more today and lock in higher selling prices forward, okay? So you've seen these higher prices. Hogs are, I don't even know where they're trading right now, but they're $100 per pound. And I can't even remember the units of lean hogs. I used a bad example. But anyway, if they're $100 per pound or what have you. Actually, I'm gonna go look that up. Hang on. Okay. Well, I hope that didn't take too long. It should have seemed mostly instantaneous to you, but it's starting to bother me because I used to trade lean hogs as part of a fund we used to have. Anyway, it's cents per pound or dollars per pound, but right now it's like 84.5 cents per pound, and the contract size is 40,000 pounds. But anyway. So where was I? So if you're a hog farmer and the forward price is, instead of 84 cents, it's $1 a pound, and it makes you say, hey, I'm going to grow some more hogs and I can lock in today that $1 a pound, then you could, at least in principle, having more money flow into commodity indices could, in theory, create a bust in prices because we're going to have a lot of hogs forward. Okay, but at the end of the day, people need to eat and build things and drive vehicles and all that stuff. So there's some fundamental value to the commodities that you end up with. And the bottom line is it probably doesn't affect spot prices very much one way or another. Anyway, those are very different situations, is my point, between commodity funds and a crypto fund, because with if you're a mutual fund holding BTC, you're actually holding those lean hogs. You're actually holding it. You're actually creating the end demand. Your commodity fund can't run out of things to buy. Your equity mutual fund can't run out of things to buy. If you buy all the stocks out there, companies will issue more stock. Your bond mutual fund can't run out of things to buy. If you buy all the bonds, people will issue more bonds. From time to time, people worry about whether or not there won't be any treasuries to buy or munis or something very specific, but there's no hard cap, and those will eventually, tend to adjust. With BTC, there is a hard cap, and it's written to the structure of most types of crypto. That's supposedly part of the appeal. It's limited supply, absolutely, by the structure. So it's important to remember that the higher that crypto climbs, the worse the use case for crypto, for actually using it for transactions, the worse that case becomes. At $1 billion per BTC, it's not going to be nearly as useful. It's going to be scary, right? You also have tons of volatility then in actually holding it. So if you're a day trader, crypto and the ETFs and mutual funds based on them will be fun trading tools. I would suggest you want to be long them at the moment, because having mutual funds almost guarantees the blow off eventually. But as an investor, I cannot recommend strongly enough that you avoid that space. There is no investment thesis for crypto itself. Gold is different. There is a long-term investment thesis, and if you buy gold here, I think it's too high. But over time, it'll keep up with the price level. Just realize that over time can mean 40 years. Gold absolutely has lived up to that long-term promise. In the shorter or medium term, it's a real rates product, and so when real rates are low, TIPS yields are low, and or gold prices are high, you don't want to buy it as much. And when real yields are high and or gold prices are low, you want to buy it much more. I liked gold 10% lower. I don't hate it here, but unlike a stock which might have 40% upside and which should over time outperform inflation because the company is creating value, Holding gold isn't creating value, and you shouldn't expect over time to do better than tie inflation unless you buy it really cheap like it was in 2000. Crypto is not a real asset. Gold is. If your real asset fund or advisor is including crypto in the universe of holdings, run away because they don't know what they're doing. Now, none of what I've just said, which is regarded entirely fairly as being very damning of crypto mutual funds and ETFs, none of that means that crypto technology can't be a crucial part of our finance industry's future. It's amazing stuff, and the technology itself is amazing. And companies that utilize that technology might have a tremendous amount of value. So I'm not saying anything about that. Okay, I'm saying that the actual units of the coins themselves, and for that matter, what I've said doesn't mean that crypto itself might not someday become a useful or even a dominant medium of exchange someday. But I think we're going to have to wait on the latter until after the tulips crash. I don't want to try to figure out how good of a medium of exchange it's going to be when it's got volatility and prices going to the moon. So someday it may be, crypto, some forms of crypto may be useful mediums of exchange, but right now they're just trading vehicles. So that's all for today's podcast. And you can see it's a long podcast. I mean, I only meant to talk about gold and gold and crypto, and it ended up going for half an hour. Anyway, please like the podcast, subscribe, refer others. I'd like to get these subscriptions. I'd like to get the listening numbers up a little bit more. So please help me with that, and share this with your friends and your enemies. You can contact me at inflationguy@enduringinvestments.com. Subscribe for free to the blog at inflationguy.blog. Follow me on Twitter or X at inflation_guy. Visit Enduring Investments if you have an inflation challenge. And most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.